Good morning everyone. This video will explain what is Tobin's Q and how it is related to investment. First, I will give a background about Tobin. Tobin's Q was popularized by James Tobin and invented in 1966 by Nicholas Caldor. Tobin is a American economist who received a Nobel Prizes for his analysis of his financial markets and their relations with employment, production, and prices. He is also a Keynesian economist. To answer the question, what is Tobin's Q? According to Tobin, the market value of the installed capital should be equal to the replacement cost of the installed capital. Many macroeconomists consider the market overvalued when Tobin's Q is above its long-term mean and undervalued when it is below the long-term mean. It plays an important role in many financial interactions. Q has been employed to explain a number of diverse corporate such as cross-sectional differences in investment. Tobin's Q measures the wealth generated by its company for each shareholders. It compares how much more a company is worth when compared to the book values of its shareholders. In real life, it is very difficult to estimate the replacement cost of all assets. That is why they modified the original formula in which the replacement cost of all assets is replaced with their book values. The Q ratio expresses the relationship between market valuation and intrinsic value. In other words, it is a means of estimating a given business or market is overvalued or undervalued. Tobin conveyed that net investment should depend on whether Q is greater or less than 1. If Q is greater than 1, then firms can raise the value of their stocks by increasing capital. And if Q is less than 1, the market values capital at less than its replacement cost, and thus firms will not replace their stocks as it wears out. A high Q ratio is generally considered good because it indicates that the company is worth more than the sum of its assets. But since it's based on historical data, it is not a good predictor of future returns of company's equity. In valuation context, a high Q ratio might indicate the company's stock is overvalued. Thank you, that's all.